Do you believe someone can make $100 million in a single day using just one technical signal? It sounds impossible, unreal, but in the chaos of Black Monday 1987, that's exactly what Paul Tudor Jones did. One signal, one conviction, and he walked away with a nine-figure profit. Adjusted for today's value, that's nearly $300 million. In today's video, we'll uncover 1. Who Paul Tudor Jones really is. 2. How he turned one market signal into a historic trade. 3. The timeless trading philosophies behind his success.
Part 1. Who is Paul Tudor Jones? Paul Tudor Jones is one of the most successful traders in modern history. A billionaire hedge fund manager with an estimated net worth of around $8.1 billion as of 2025. But long before the fame and fortune, he was just a young man from Memphis, Tennessee, obsessed with understanding how markets move. After graduating from the University of Virginia in 1976 with a degree in economics, Jones started humbly, working as a clerk on the trading floor of the New York Cotton Exchange. It was there he met his mentor, Eli Tullis, a legendary cotton trader who taught him two lessons that would define his career. Protect your capital and never let your ego trade for you. In 1980, Jones founded Tudor Investment Corporation with a single goal: to trade global markets through macro strategies. He looked at the big picture: interest rates, currencies, commodities, and stock indices. While most traders focused on one asset or one market, Jones was connecting the dots, identifying how everything moved together.
He was one of the early pioneers of what we now call global macro trading. By the mid-1980s, his performance was extraordinary. Consistent double-digit returns built on strict risk management and deep pattern recognition. But his defining moment came in 1987, when he predicted the biggest market crash of the 20th century and turned that insight into one of the most profitable trades ever made. What made Paul Tudor Jones a legend wasn't luck or timing. It was vision, discipline, and the rare ability to read market psychology like a book. And that leads us straight into Part 2, the trade that made $100 million.
Between 1984 and 1987, Paul Tudor Jones and his chief analyst Peter Borish started to notice something unusual forming in the markets. The S&P 500 wasn't just rising, it was accelerating, almost vertically. Prices were climbing faster and faster, showing what traders call a parabolic curve, a classic sign that euphoria was taking over. To Jones, this wasn't a healthy bull market. It was a bubble waiting to burst. Borish began digging deeper. Using historical data, he overlaid the 1929 Dow Jones chart right before the Great Depression with the 1980s S&P 500 chart. The result was chilling. The two patterns were almost identical. Every rally, every dip, every surge, the rhythm of the market was repeating itself.
To Jones, it wasn't superstition or luck. It was crowd psychology, repeating across decades. He once said, "The market is nothing more than human emotion reflected in prices, and human emotion doesn't change." Still, recognizing a bubble and timing its collapse are two very different things. For that, Jones relied on one of his favorite tools, the 200-day moving average. It's simple but powerful. Since there are about 200 trading days in a year, this line represents the market's long-term heartbeat. When prices stay above it, the trend is healthy. When they break below it, something fundamental has shifted. In October 1987, that shift arrived. The S&P 500 began rolling over, momentum slowing, price slipping beneath the 200-day moving average. That was Jones' trigger. He didn't hesitate. He went short, aggressively, across stock index futures.
Then came Monday, October 19, 1987. The Dow plunged 508 points, a staggering 22.6% drop, the largest single-day decline in U.S. history. As chaos spread across trading floors, Paul Tudor Jones' conviction paid off. He reportedly made $100 million in one day, while most funds lost billions. But it wasn't just about one chart or one lucky call. Jones combined pattern recognition, macro awareness, and disciplined risk control, a balance of logic and intuition few traders ever master. He once said, "The whole trick in investing is, how do I keep from losing everything?" That question guided every trade he made. And that brings us to part 3, Paul Tudor Jones's timeless trading philosophies, the principles that turned one great trade into a lifetime of consistent success.
After the legendary trade of 1987, many began to call Paul Tudor Jones a contrarian, the kind of trader who bet against the crowd. But that label misses the truth. Jones wasn't fighting the market, he was simply trying to catch the turn, the exact moment when sentiment shifted and a new trend began. Jones famously said, "I believe the very best money is made at market turns. Everyone says you get killed trying to pick tops and bottoms. Well, for 12 years I've been missing the meat in the middle, but I've made a lot of money at tops and bottoms." To him, the most profitable opportunities were born out of change. When everyone felt safe, he grew cautious. When panic dominated, he looked for reversal signs. But this approach required something most traders don't have: the willingness to be wrong again and again.
Catching turns isn't glamorous. It means taking small losses repeatedly while waiting for that one moment when the market truly breaks. It demands emotional resilience and unshakable discipline. Jones had both. He accepted being wrong as part of the game. He wasn't predicting, he was positioning. That's what separated him from gamblers. He waited for confirmation, acted decisively, and managed risk like a surgeon. For most traders, following the established trend is safer. There's less volatility, fewer false starts. But Jones had trained himself to thrive in uncertainty. He once said, "Don't be a hero. Don't have an ego. Always question yourself and your ability. Don't ever feel that you are very good. The second you do, you are dead." Humility, not confidence, was his edge.
2. Small losses, big wins. If there's one principle that defines Paul Tudor Jones's entire philosophy, it's this: protect your capital at all costs. He once said, "I'm looking for 5-to-1 risk-reward. That means I'm risking $1 to make 5. I can be wrong 80% of the time and still not lose." That mindset changes everything. It means Jones never needed to be right often, only disciplined. He would take small losses again and again without hesitation. If a trade went against him, he'd exit immediately. If it moved in his favor, he'd let it run as long as possible. He summed it up perfectly. If I have positions going against me, I get right out. If they're going for me, I keep them. Risk control is the most important thing in trading. This simple philosophy, small losses, big wins, is why he survived when others blew up. He understood that trading isn't about being a genius. It's about staying in the game long enough for the odds to work in your favor. In the end, that's the true legacy of Paul Tudor Jones. Not just predicting crashes or catching turns, but mastering the hardest part of trading, himself.
So if there's one lesson to take from Paul Tudor Jones, it's this. Preparation beats prediction. Discipline beats emotion. Survival beats ego. And if this story gave you something valuable, a new perspective, a spark of motivation, then take a moment to give back. Hit that like button, subscribe to Dollar Wisdom, and share this video with someone who still thinks trading is just luck. And if you want to help us keep creating content like this, you can tap the Super Thanks button below. It's a small gesture that makes a big difference in keeping financial wisdom free for everyone.